Isn't that fascinating? There is this battle between the Bitcoin maximalists and the people that support Ethereum. It's Michael Saylor versus Tom Lee. It's store of value versus leading smart contract platform. But really, are the assets from an investment perspective really that different mathematically speaking? Let's have a look at a comparison between the two and try to figure out what's the best allocation. Currently, both assets fight for the same kind of investor. They fight for the same capital. And that fight is best expressed over here with the Bitcoin market cap relative to Ethereum market cap over time. So this is ETH relative to BTC. In anticipation of the merge, so the move from proof of work to proof of stake, Ethereum outperformed Bitcoin massively. Then came that merge, and at the same time, more and more money got into Bitcoin through the Grayscale Bitcoin Trust and afterwards through the Bitcoin ETFs. That's when Ethereum underperformed Bitcoin by 80%. But now with the Ethereum treasury companies that started acquiring in April of this year, we are starting to see outperformance again. So far by more than 100%, and we might just be halfway through that rally. From an investor perspective, the assets are more similar than different though. The correlation between the assets is massive. When Bitcoin goes up, Ethereum tends to go up as well. When Bitcoin goes down, Ethereum tends to go down as well. So the correlation between Bitcoin and Ethereum is much stronger compared to, say, Bitcoin and the Nasdaq 100 or Bitcoin and the S&P 500. Within crypto, there is a lot of commonalities in terms of price development. And so here's the balance of Bitcoin through the Bitcoin ETFs. We've got quite a bit of history, and we never really saw this balance go down for an extended period of time. Yes, Grayscale lost market share over time because that was the Grayscale Bitcoin Trust initially that got converted into an ETF. It is very expensive in terms of management fees, and so BlackRock took over the vast majority of ETF market share. Here's the same picture for the Ethereum ETF. Here we did not see initial adoption. Only after the announcement of Ethereum treasury companies did we also see Wall Street buying into the ETFs. Now for both Bitcoin and Ethereum, the ETFs tend to hold more balance than the treasury companies. So for Bitcoin, there's roughly 7.5% of the entire supply in the ETFs, so 1.5 million BTC. But there's only 1.1 million held by the treasury companies, which of course is spearheaded by MicroStrategy, now just called Strategy. The same is true for the Ethereum treasury companies. We see constant growth here that's led by Bitmain. But the balance that's held through the ETF, which currently is 6.6 million Ethereum, or a bit over 5% of the supply, is more than what's held by the strategic Ethereum reserve companies. The strategic reserve companies only have roughly 4% of the supply. And here is the ETFs that have more than 5%. So the dynamics in terms of capital movements are very similar. We've got the reserve companies, we've got the ETFs. Both of those balances for both assets are increasing over time, which in the end will of course lead to a shrinking circulating supply. So if we continue to see the same kind of interest by the retail investor, we should actually see above average returns for every dollar that's flowing in. Because the less liquid an asset is, the more impact every additional dollar has on the price development. The sensitivity in terms of price performance relative to the inflows is dependent on the liquid supply, not on the overall supply. Now, since there are so many commonalities in terms of capital flows, not necessarily in the underlying nature of the asset, right, store of value versus smart contract platform, but in terms of price movements, in terms of capital flows, there seems to be many similarities. Why don't we just add both of those market caps together? So Bitcoin's market cap plus Ethereum's market cap, and compare this to the rest of crypto. Intuitively, we would expect that the market cap of Bitcoin plus ETH should be outperforming the rest of crypto by quite a bit with all of those Wall Street inflows. But actually, the difference isn't really that large. I was surprised when I saw this chart here. This is the Bitcoin plus Ethereum market cap relative to all of crypto. And yes, the ETFs and the treasury companies did have an impact. They did cause Bitcoin and Ethereum to outperform the rest of crypto. But have a look at this magnitude. It's only 24%. What's going on here? There's billions and billions of dollars flowing into Bitcoin and Ethereum. The circulating supply gets stashed away. Yet the outperformance over the last 3 years was a meager 24%. This doesn't seem right. What's going on here is that many altcoins are directly coupled, especially to Ethereum. So when Ethereum is going up, then as per default, many altcoins go up as well. So seeing all of this green here is not necessarily an expression of retail suddenly buying all of those altcoins. What's actually happening is that the altcoins are going up because the liquidity pools are against wrapped Ethereum. So have a look at this. This is the Ethereum chain, but we can do the same for the base chain or for Arbitrum or for Optimism. Many of the tokens on those chains, so on the layer 1 Ethereum or on the layer 2s, they are bound in liquidity pools versus wrapped Ethereum. So really, the price discovery in this example, say of SPX 6900, it doesn't happen in US dollars. It happens as the ratio within the liquidity pool. So how many SPX tokens are in the pool versus how many wrapped Ethereum are in the pool. And the ratio of those two numbers determines the price. SPX is priced in wrapped Ethereum, not in US dollars. So when Ethereum is going up by 10% because of the ETFs, and because of the treasury companies, then automatically SPX 6900 in this case also goes up by 10%. This is a direct coupling effect. And so there's a direct spillover. If you've got your fiat currency or your stable coins in a centralized exchange, and then you're buying a meme coin like SPX 6900, what's actually happening in the background is that your stable coins get converted into Ethereum, and then from Ethereum into SPX 6900. Money that's flowing into ETH is also directly profiting all the altcoins that are coupled with ETH as well. But the same is true the other way around. So if you're now holding your SPX 6900 and you're then selling this, then of course the price of SPX relative to Ethereum is going down, but also the capital is flowing out of the Ethereum ecosystem. So there's also sell pressure on ETH. And so this is what many people are not talking about. This is the total value locked in US dollars on the Ethereum chain over time. We had DeFi summer where we went all the way up to 110 billion almost worth of capital on the Ethereum chain. And then came the Terra Luna collapse, then came FTX and DeFi winter. Thus, the total value locked shrank all the way down to 21 million. And now it has recovered to almost the old heights. But this is only half of the story. It seems like we are still in growth mode. But that's actually not true. Have a look at the total value locked measured in Ethereum. This has already peaked. And the peak was in the middle of April. So since we saw all of those inflows from the treasury companies and from the ETFs, the total value locked measured in ETH went down. The Ethereum price went up and the Ethereum market cap relative to the rest of crypto went up. But DeFi, decentralized finance, did not grow to the same extent. The usage of the blockchain is actually lagging behind. In the end, there's really only two drivers for crypto prices. There is the in and outflows from the fiat traditional finance ecosystem into crypto and from crypto into traditional finance. That's driver number one. Driver number two is the swapping activity. So how are people currently risk on or risk off? Are people currently rather in stable coins or are they risk on and swapped into the altcoins or into Ethereum? The timescale of those two effects are vastly different. What we see here is the stable coin market cap over time. It peaked in April of 2022, then came the Terra Luna collapse. So this is then when also FTX went belly up. The stablecoin market cap shrunk. That means people swapped their stablecoins into fiat currency again. People wanted to get out of the ecosystem as a whole. So that's then when the stablecoin custodians are burning the stablecoin supply and issue the actual fiat currency in a bank account again. Have a look at the Bitcoin price over the same time. It tended to go down. But then have a look at what happened in October of 2023. So that's now 2 years ago. The stablecoin market cap tended to recover. People deposited into crypto again. So money is flowing into the system. And so Bitcoin tends to go up. Now let's compare how much both of those numbers grew. The stablecoin market cap in the last 2 years went up by 113%. Bitcoin, on the other hand, went up by 284%. So there is inherent leverage. There is price sensitivity. Every additional dollar that flows into the crypto ecosystem tends to increase the market cap by more than $1. So when the stablecoin market cap is doubling, crypto prices tend to more than double. And that's even true for the largest and least sensitive of the cryptocurrencies, which is Bitcoin. And so on the grand macro, we are still in a bull market. Money is still flowing into the space. And again, that's true since October of 2023. But still, even during that time, we did get our corrections. This is a 28% drop. And that happens because of effect number 2. So this is not in and outflows from the ecosystem. It's how much are people currently risk on or risk off within the ecosystem. Are people currently swapping into stablecoins or into the altcoins and into Ethereum? And we can, of course, also measure that effect. That's the stablecoin dominance. So how much of all of crypto in percent is currently in stablecoins? When this is very high, then the market is risk off. There's a lot of dry powder on the side. When this is very low, the market is very much risk on. So any additional price appreciation has to come directly from traditional finance because the market itself is already very much deployed. At the beginning, we simply saw more and more adoption of stablecoins. That's why the stablecoin dominance went up. But in the last 2 years, we are trading in a range. And have a look at the Bitcoin price at the same time. When the stablecoin dominance is low, the Bitcoin price tends to be high. When the stablecoin dominance is high, the Bitcoin price tends to be low. So it makes sense, potentially, when we trade short term, to sell whenever we are low and to buy whenever we are high. And currently we are coming down, so that's why the Bitcoin price is going up. The stablecoins are getting deployed, but we are not yet at 5% in stablecoin dominance. This is when it might make sense to sell, because as the market gets more risk off, if the stablecoin dominance rises, crypto prices should go down. So the effect is exactly inverse. Crypto is going up when stablecoins get deployed. Crypto is going down when people swap back into the stables. And so really, a lot of disagreement within the crypto space, whether prices will go up or will go down, just boils down to the time horizon. In the medium term, over the next months, we're likely going to continue to see rising prices because money continues to flow into the system. Stablecoin market cap is going up, more and more purchases happen through the ETFs and through the treasury companies, so it's very likely that in a few months we will see higher prices. But in the short term, it's not so clear. Because relatively speaking, there isn't that many more stablecoins that are ready to be deployed. The stablecoin dominance is already comparatively low. Yes, we could go lower very, very short term over the next 1 or 2 weeks. But in general, right, the stablecoin dominance is now at 6%. It might fall down to 5%. But at that time, once we are at 5%, we tend to be maximum risk on. And then any kind of negative news we get might have above average impact on the price. If people are already maximum deployed and there's something that's not 100% bullish, the market reacts quite drastically. This is definitely what could happen again. We might see a bit more price appreciation and then a medium term cooling off to then over the long term, of course, continue to appreciate as money flows into the system. This is how I believe the mechanics in crypto really work. Now with content like this, I don't just want to help us beat the market. I don't just want us to make more money. I actually want to really have an impact on financial literacy. I want that after watching some of the videos here, you will act better with your overall portfolio long term. Because while it's nice to see backtests like this that tend to outperform just buying and holding Bitcoin, and it's also nice that there's now a copy trading pool where people here in the membership get very high outsized returns compared to the risk. And why those strategies also work pretty well for me over time, right? The gray line is buying and holding Bitcoin. The black line is what I achieved over the last 4 years roughly. And while all of this is nice and useful, what really matters long term is risk-adjusted return. Because many people become millionaires short term on paper to then just afterwards lose it all again. I know it's not a sexy topic, but really what matters long term is skill. It's not just figuring out a single market. It's about figuring out how to manage wealth long term, how to be able to preserve purchasing power and build upon this year over year. For example, have a look at this video here. The very first video that I published in Premium, the different steps of wealth building. When should we move from selling our time to actively trading to then just allocating towards a portfolio? How can we in general take advantage of our monetary system since the money supply is expanding all the time and the US dollar is devaluing? There are a few winners in the system, but most people lose. And this video explains how this all works. works and how we can take advantage of the monetary debasement. For this here, the fundamentals of portfolio allocation, or how to hedge macro risk, right, step by step. Or here, things like long-term expected returns and target allocation. Because that's a problem with most people. Most people just wing it. They don't really think about this deeply. How much should I have in crypto and in stocks and in gold and in property? How is this properly split up? How should I adjust this based on how I see the economy going? What's actually reasonable? These questions are much more important than trying to find the next altcoin. We can even dive a bit deeper into the numbers and try to risk adjust individual positions and calculate things like alpha and beta. People throw numbers like alpha around all the time, but they don't really know what it means. Individual winning trades are great. And yes, we do have this in premium as well. And I share my individual trades as well. But really, the thing that really matters is risk adjusted long-term outsized returns. Making more money than just buying and holding stocks or just buying and holding Bitcoin. Having the right mix, having the right rebalancing approach, knowing exactly how to approach different situations. That we don't have to ask ourselves, should we buy this crash or should we now sell because the thing went up? We actually have a systematic approach, again, that most people don't have. I know this is not the sexy sale. The sexy sale is to just talk about the next 100x altcoin that more likely than not will go to zero. But even if you're lucky enough to hit the next 100x, the chances are that you're going to lose everything again. Most lottery winners are going broke 5 years after the win. It's unlikely that you're going to make money with any of those predictions. But even if you do, the likelihood of losing it all afterwards is extremely high. It's much better to take the time and learn the actual craft of proper wealth management. And only then, once you know what to actually do in certain periods, in certain situations, only then can you keep and steadily grow wealth. I do not believe that you can just wing it. It's simply too complex. You can actually watch all of the premium tutorial videos just by signing up for $125 per month. And if you don't like what you see, you can just message me within the first week and I refund you 100%. If you want to become part of the next copy trading pool, which right now is closed for deposits, but a new one will open at the beginning of next year, then you can also consider joining the yearly membership. So yearly members will get access to the copy trading pool the earliest. And so be careful who you trust out there. Don't just gamble with your wealth. Try to accumulate enough wealth at the beginning by selling time, have enough capital to invest, and then grow this slowly over time in a smart way that there's still outperformance, but there's not too much risk. Long term, again, it's all about risk adjusted returns. If it's your very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.